No idea what they do, really don't care, actually don't want to know. I hate knowing. I just want to trade the chart. The entry signal came this morning on this action candle after the gap up. And we know that gaps are always a little bit cautionary. Now the gap wasn't huge compared to past trading days, so it was okay. But this one was nice in that it pulled back after the action candle. So when we talk about entry on a second signal, this is a great example because it pulled back, and then that allows you to put a buy stop in at the action candle close, which is 131. You can add a penny onto that, 132. So in other words, a buy stop will trigger at $1.32 to buy the shares. In this case, for every $100 of risk, you would buy 760 shares. If you want to take $200 of risk, you buy 1,520 shares. Now the capital required to do that was just under $1,000, which implies a 10% drawdown potential. But of course, we don't put our stop at -1. We can go a little below the low of the day, or if you really want to increase your probability of success, then you can put your stop at -3, -5. Statistically speaking, -5 tends to work the best. -3 is also good. -5 is, I've done some in-depth analysis using the data, and a stop at -5 actually is the most profitable that I've tested. Not everyone can stomach -5, so -3 is another candidate because it is also quite profitable. But just so you know, the difference between a stop at -1 and -3 is double the profit. So in other words, having the wider stop doubles your overall profit because it allows the stock more wiggle room. All right, so let's wind it back to how it looked at that moment. And we'll go through this chart as time progresses. So there was the big gap, and it was not very liquid. I had a few issues with it, but nonetheless, I loved the abnormal volume. That's the sign of alpha that we need, and it's a stock that nobody cared about, and then it came alive. All right, so it pulls back, awesome, allows you to put a buy stop in at 132. You get filled on that buy stop at 956. All right, so the stock goes up. It gets to +2. At that point, one option is to tighten your stop. You could either go to break even. In this case, because it was quite volatile, to me that would be a little too tight. And so I would suggest just going below the low. And so somewhere in the neighborhood of $1.12, $1.13 would be a reasonable place to put the stop. That way your risk is truly $100 or maybe a little more, $140 for assuming you took on a $100 risk size position. All right, so stock does this. Now, at this point, we have a scale-in signal because we're breaking a pullback right here, and the new support price is higher than the previous entry signal. So that would be a signal to double the position, perhaps. That way, if this position fails and you come back below this support, the first position is still going to be slightly profitable or perhaps break even with some slippage. And so you're not really taking on more risk when you do that. All right, so now you've got double the position. At this point right here, your first position is up +2, and your second position is up a little less than 1. So instead of being up just +2, you're up just under +3. Moving along. Now some might say, is this a new scale in? To me, not really. It's not enough of a pullback. This is an obvious flag pattern. This is kind of choppy, so I would not use that as a scale in, although it was close. Okay, now it really starts to stretch its legs. It kind of goes parabolic. And so you wouldn't be faulted for wanting to take some money off the table there on that red candle because it is a bursting bubble. Strong volume, hits new high, closes below its open. That is a bursting bubble. It has not, however, broken the linear upward trend line. And so you might just say you're going to stick with the trade. Now, if you sold it there and then you get this flag break, that would be a signal to re-enter. If you did not sell here and you get this flag break, then that would be a signal to scale in again, because much like this pattern is a flag, a pullback for a while, this is a break of another pullback. The entry point is, or sorry, the new support price, which is your last inflection point, call it $1.99 as a good area of support, is significantly higher than your last entry. And so your first entry is up at this point plus 6.5. Your second entry is up plus 5.5. And so you're now trading with the house's money. Because if you get stopped out down here, or giving it a little bit of wiggle room, you're still going to make, maybe this third position will be a loser, but your first two will be profitable. All right, let's keep it going. So now you really go parabolic here again, and you get another bursting bubble candle. So no reason not to take some money off the table there. That would be a reasonable thing to do. But again, you break the flag, and so if you sold there and took profit, you'd have a signal to buy it back. Nothing wrong with buying it back. You've got lots of profit to work with. You can use a tight stop in around 264, which is your last inflection point low. If you did not sell there, then you have a third scale in, a fourth position overall to add more. And away it goes yet again. Now here you have a bursting bubble again. You hit a new high. You're very parabolic. You can see the trend has gone parabolic. And so you might sell your position again and look for another entry point. So now for a new entry, I'm looking for a break of the pullback. And we get one right in here. You can see there's our downward trend line. We have a strong break. One of the things I like to look for when I think about breaks of pullbacks is at least half of the candle and a taller candle, not a really narrow one, but a taller candle at least half above the trend line. And so we have that right here at 158. And it's also made its way back to the linear trend line. It took out the parabolic state and it broke here again. So if you sold up here, you might buy it back there. Now let's go back to the economics. Let's say you didn't do any sells, you just carried the position overall. At this point, you are exiting your first position at plus 16.5, your second position at plus 15.5, your third position was right here, that would be plus roughly 7 or 8, and then another position here, which would be about plus 4 or 5. So you can see that all of a sudden, instead of just making plus 15 or 16, you're actually making plus 40 because you scaled in without taking on much extra risk. Now your re-entry here is still hanging in there. It's still above support. Although now it's starting to look like the stock is maybe done for the day, going sideways, and not really making money on the re-entry. I mean, it's up very slightly. All right, so that's sort of a way to walk through exit signals, re-entries, scale-ins, all of those different things that you can think about. Now, what I just did is easy with hindsight. It is much harder to do it in real time because you get emotional, you get wrapped up in the money that's involved, but it is a pretty simple principles, and that's really what I wanted to emphasize today. Is those are the simple principles: linear trend lines, parabolic trends, bursting bubble candles when it's parabolic, pullbacks, flag breaks for scale-ins. These concepts that are all in the foundation material, but I thought this was a great example to emphasize all that. I did record this. I'm going to stop the recording now, and then we can take some questions and stock picks.